As an in-house financial expert who's helped thousands of anxious investors find clarity, I created this video to walk you through Warren Buffett, the only 3 ETFs I'd buy if I had to start over in 2020. 6 a powerful roadmap for anyone who wants to build wealth with confidence, not fear. In this breakdown, I explain why simplicity outperforms complexity, how to stay calm through market swings, and how Buffett's approach can help you invest without second-guessing every move. In Warren Buffett, the only 3 ETFs I'd buy if I had to start over in 2026, we explore the exact ETF strategy Buffett recommends for long-term success, and I translate it into practical steps you can use today. If you've ever felt overwhelmed by investing, this video will help you breathe easier and focus on what truly matters. By the end of Warren Buffett, the only 3 ETFs I'd buy if I had to start over in 2026, you'll understand how to build a portfolio that grows steadily, survives volatility, and gives you the peace of mind every investor deserves. This is guidance I've used to help clients for years, and now I'm sharing it with you. If you find value in Warren Buffett, the only 3 ETFs I'd buy if I had to start over in 2026, please like and share the video to help more investors gain confidence and clarity. And if you'd like to support the channel and help me continue producing high-quality, anxiety-reducing financial content, you're welcome. Never obligated to contribute through the donation link. Your support truly makes a difference. Thank you for being here. Let's build your financial future with calm, discipline, and wisdom. Hey everyone, I'm glad you're here. Look, I'm not going to sugarcoat this. I know what financial pain feels like. The sleepless nights staring at the ceiling, the pit in your stomach when the market dips, the stress of feeling like you're constantly behind. I've been there. And I've learned the hard way that the best defense against that pain is a solid, sensible investment plan. You don't need to be a Wall Street wizard. You need a foundation built on proven strategies. Today, I want to share a simple, powerful framework that I wish I'd embraced sooner. Look at 3 exchange-traded funds, ETFs, that in my professional opinion would form the core of a modern-day Warren Buffett-style portfolio. These are the tools that can genuinely help you secure your financial future. The 3 ETFs Buffett would buy today. This isn't about chasing the next hot stock. It's about owning a piece of the world's best businesses, automatically and cheaply. ETF number 1, VU Vanguard S&P 500. ETF, the foundation. If you learn one thing today, let it be this. VU is the absolute core of a responsible portfolio. It simply tracks the S&P 500. Which represents the top 500 US companies and about 80% of the entire US market value. You are buying Apple, Microsoft, Amazon, and yes, even Berkshire Hathaway, the dominant economic engines of the world. The power of automation. Historically, the S&P 500 has returned around 10% annually over the last 50 years. This fund automatically cycles out the losers and replaces them with winners, meaning you need to do virtually no research. You know, when I think back on my early years investing, I can still feel the sting of the mistakes I made. I chased hot tips, bought stocks I didn't understand, panicked during downturns, and let fear and ego take the wheel more than once. If you've ever felt that pain, the knots in your stomach when the market drops, the regret of buying the wrong thing at the wrong time, trust me, you're not alone. I've lived through it, and it taught me one of the greatest truths in wealth building. Simplicity wins. That's exactly why Warren Buffett, the greatest investor of our time, keeps pointing every day, folks, toward a simple, reliable strategy. And if I were starting from scratch today with everything I've learned the hard way, there are 3 ETFs, just 3 that would form the backbone of my portfolio. ETF number 1, VOO. The foundation. VOO is the Vanguard S&P 500 ETF, and I call it the bedrock of long-term wealth. When you buy VOO, you're buying a slice of America's 500 biggest and strongest companies, names like Apple, Microsoft, Amazon, Berkshire Hathaway, businesses that have shaped the American economy for decades. It costs almost nothing to own, just 0.03% annually, which is $3 a year on a $10,000 investment. And for the last 50 years, the S&P 500 has averaged around a 10% return. That's not magic. It's discipline, diversification, and the simple fact that the US economy tends to grow over time. VOO quietly replaces the losers with the winners automatically, no guesswork required. For most people, this should be the core of your portfolio, the part you let grow, untouched, through every storm. ETF number 2, SCHD, Stability and Income. Now, when I hit my 40s, I learned something I wish I'd understood earlier. Cash flow matters. SCHD, the Schwab US Dividend Equity ETF, brings stability and a dependable stream of income. This ETF focuses on roughly 100 high-quality companies that don't just pay dividends, they grow them. These are companies with more than a decade of uninterrupted dividends, strong free cash flow, and sensible valuations. The dividend yield runs around 3.5 to 4%, meaning about $400 a year on $10,000 invested. During tough market years, SCHD tends to hold up better than growth-heavy funds. And in retirement accounts, reinvesting those dividends can be incredibly powerful. Just look at Berkshire Hathaway earning roughly $700 million every year from Coca-Cola dividends alone. That's the power of time and consistency. ETF number 3, QQQ, Growth and Innovation. Now this third one, QQQ, is not for the faint of heart, but it's where some of the most explosive innovation happens. QQQ tracks the NASDAQ Q100, packed with giants like Apple, Nvidia, Amazon, Tesla, Meta, and Microsoft. It's the most volatile of the three. In the early 2000s, it fell more than 80% during the dot-com crash. But here's the jaw-dropper. Even if you had bought at the absolute peak of the dot-com bubble and held until today, you'd still have earned around 14% annually. QQQ rewards patience and the willingness to ride out big drops. This is the fund that reflects the future AI, cloud computing, robotics, biotech, and all the innovation built by the companies shaping tomorrow. How you might allocate them, there's no perfect formula, but here are simple examples based on age and risk tolerance. Younger investors, 20s to 30s, 50% View, 20% SCHD, 30% Q. For more time equals more room for growth swings. Middle-aged 40s, 50s, 60% VOO, 30% SCHD, 10% QQQ, more stability, some growth, near or in retirement, 70% VO, 30% SCHD, 0% QQ. Focus on dependability and income. Let me tell you something I wish someone had pulled me aside and explained when I was younger, back when I was juggling bills, losing sleep, and feeling like everyone else had some secret playbook for building wealth except me. The truth is, wealth isn't magic, it isn't luck, it's math. It's time, and it's the discipline to stick with a simple plan long enough for it to work. I want to walk you through a scenario I wish someone had shown me in my 20s. Scenario that proves you, Dan T., need millions to start with. You just need to start. Imagine you're 30 years old. You've saved up $100,000. Not easy, I know. Maybe that money came from grinding through long work weeks, skipping vacations, living below your means when no one else seemed to be doing the same. I've been there. But here's where things start to turn in your favor. You take that $100,000 and commit to adding $10,000 every year. Nothing crazy, just consistency. Then you invest it not in something flashy, but in a long-term, diversified portfolio that historically earns around 9.5% a year. That's a conservative number over the long run. Now, here's where the math gets beautiful. If you stay the course, resist the emotional roller coasters, and ignore the noise that scares most people out of the market, by the time you hit age 65, that account will have grown to $6.6 million. Read that again. From $100,000 and steady contributions, you end up with over $6.5 million. And here's the part that changed how I look at money forever. Once you retire, you can shift that portfolio into something designed for stability, earning around 7% a year. That 7% alone generates $460,000 every single year. Now let's say you don't need anywhere near that level of lifestyle. Maybe you live comfortably on $100,000 a year. That means your investments continue growing even while you're retired. You never run out of money. In fact, your wealth keeps compounding, leaving behind millions for your children, grandchildren, or any legacy you want to pass on. That's the quiet power of compound interest. It doesn't feel dramatic year to year, but give it time, and it transforms your entire life. I've lived through the stress of not knowing if the future would be secure. I've had to claw my way out of financial fear. And that's why I am telling you this with full sincerity. You, Dan T., need to be a genius. You don't need special access. You just need patience, discipline, and the courage to start. When I talk about investing, I am not speaking as some guy who read a few books and decided he suddenly knew everything. I'm speaking as someone who's been bruised, humbled, and thankfully eventually rebuilt by the markets. I've lived through the mistakes, the bad advice, and yes, the painful fees that quietly bled my wealth when I wasn't paying close enough attention. One of the hardest lessons I learned I wish someone had pulled me aside and explained years earlier, is just how devastating high investment fees can be over a lifetime. Not dramatic fees, not scams, not anything that would make the headlines. I'm talking about the quiet, polite fees hidden in actively managed funds, financial products with shiny brochures, and advisors who charge you just 1% for the privilege of underperforming the market. Let me give you a simple example that changed my own behavior forever. Imagine you're doing everything right, saving $10,000 a year, invested in a solid portfolio, averaging around 10% annually, over a career that builds into a beautiful nest egg somewhere around $6.6 million. That's the kind of number that buys you freedom, flexibility, peace of mind. But now imagine those returns quietly drop to 7.5%. Maybe it's because you were sold into high-fee funds. Maybe it's because your advisor is picking active managers who rarely if ever beat the market. Doesn't sound like a big difference, right? Just a couple percentage points. Well, here's what happens next. Suddenly, to reach the same goals, you don't need $10,000 a year. That's a $2.6 million difference. Not because you didn't work hard, not because you weren't disciplined, simply because your money was being siphoned off through fees and consistent underperformance. And here's the part that really hit me in the gut when I ran the numbers. With that smaller nest egg, you're far more likely to run out of money. In fact, instead of your savings lasting comfortably into your 90s, you may find yourself out of funds by age 83. You deserve better than that. Your family deserves better than that. Look, I'm not telling you this to scare you. I'm telling you because I wish someone had been honest with me much earlier. You don't overcome financial pain by avoiding the truth. You overcome it by facing it head-on and choosing a better path. Be ruthless about fees. Question every cost. Favor low-cost index funds, unless you have a truly compelling reason not to. And remember, every percentage point you save on fees, isn't just a number at years of retirement, vacations with grandkids, breathing room, and dignity. I've spent a big part of my life learning the hard way that your investments grow because you hope they will. They grow because you build a strategy that quietly works for you every single day, even when you're not looking. And believe me, I wasn't always the guy with a plan. There were years when I chased the wrong stocks, panicked at the wrong moments, and ignored opportunities that could have changed everything. That's why I want to share something with you today that I wish someone had told me earlier in my journey. Let's talk about growth, real, measurable growth that can turn an ordinary retirement into a comfortable one. A lot of people build their portfolio around broad-based index funds, and that's a solid foundation. But here's the truth. Most beginners don't here. If you tilt just a bit toward innovation and technology, you can significantly shift your long-term results. That's where QQQ comes in. Now, I'm not talking about going all in or taking wild risks. What I'm talking about is a simple, smart move, allocating 20% of your portfolio to QQQ, an ETF that tracks some of the most innovative, fast-growing companies in the world. Companies that shape the way we live, work, communicate, and even think. When you look back on the last couple of decades, tech hasn't just grown, it's redefined the economy. And here's the part that still blows people away. That 20% tilt toward QQQ historically boosts your overall return by about 0.8% per year. Now, 0.8% might sound small, but I've lived long enough and invested long enough to tell you that in the world of compounding, small numbers turn into life-changing ones, because that little boost doesn't stay little. When you zoom out and look at a full investing lifetime, that higher return lifts your total annual performance from around 9.5% to roughly 10.3%. And that difference, over decades, turns into real money. We're talking about a retirement portfolio that grows to about $8.17 million instead of $6.6 million. That's an extra $1.57 million without working harder, without picking individual stocks, without timing the market, just by giving a portion of your portfolio exposure to growth. I can't tell you how many times I've met people, smart, hard-working people, who say, if only I'd started sooner, or if only I'd positioned myself differently. I was once one of them. So if you take anything from me today, let it be this: you don't have to be perfect, you just have to be intentional. Build a foundation, add a touch of growth, let time do the heavy lifting. I want to share one of the most underrated wealth-building strategies I've ever used, something that helped me turn years of frustration into real momentum. It's called selling covered calls and cash-secured puts. Now, before your eyes glaze over, stick with me. This is not day trading hype or some get-rich-quick trick. It's a conservative, disciplined strategy used by professionals to quietly earn a little extra return on stocks they already own or stocks they want to own at the right price. And here's the magic: used properly, this strategy can add an extra 1 to 4% per year. Doesn't sound like much. Let me show you why it matters. Say you're consistently adding just 1.5% a year on top of your normal investment returns. That bumps a typical long-term return from around 10.3% to 11.8%. Over a lifetime, that difference is enormous. We're talking about turning an average retirement portfolio into something around $12.10 million by age 65. And if you manage it wisely through retirement, you're looking at over $127 million in total lifetime wealth. I want you to really let that sink in. This isn't lottery luck. This is math, slow, steady, disciplined, compounding. But let me be brutally honest, this strategy is not where you start. It's advanced. It requires understanding, patience, and the ability to stick to your rules even when the market tries to scare you into doing something dumb. When I first learned it, I made mistakes because I tried to rush. I tried to get clever, and I thought I knew more than I did. Eventually, after some painful lessons, and trust me, the market is a ruthless teacher, I learned to use it conservatively. That's when it became one of the most powerful tools in my entire financial playbook. And that's what I want for you. Not shortcuts, not speculation, but smart, disciplined steps that quietly build wealth year after year. If you're going to explore covered calls or cash-secured puts, do it with respect for the process. Understand the mechanics. Start small. Practice on paper if you need to. Because once you grasp it, once it clicks, you'll see how professionals generate steady, predictable returns, even in sideways or choppy markets. I'm sharing this not as some guru looking down from a mountain, but as a guy who struggled, learned, and came out the other side determined to help others skip the pain I went through. You deserve a future where your money grows with confidence and consistency. You deserve options. You deserve stability. And strategies like this can help make that future real. If there's one truth I wish someone had drilled into me early on, it's this: the hardest part of investing has nothing to do with numbers. It's all psychology. People think investing is about finding the perfect strategy or cracking some secret formula. Let me tell you, the math is the easy part. What really tests you is your temperament. I've watched smart people who could run circles around others in spreadsheets, completely fall apart the moment their portfolio dipped. I've also seen ordinary folks with modest means quietly build wealth just because they had one thing most investors lack: emotional discipline. The biggest mistakes aren't hidden in complicated financial products. They show up in very human behavior. Panic selling when the market crashes. I've done it. You feel the fear in your gut. You see the red on the screen. And suddenly, the long-term plan you swore you'd follow evaporates. You tell yourself you're protecting your capital, but really, you're letting emotions run the show, chasing hype during booms. I've bought into the excitement too. Everyone's making money, so you feel like you have to jump in before it's too late. But that feeling, that rush, it's a trap. Markets punish emotional decisions more ruthlessly than any competitor ever could. Overtrading when I was younger, I thought activity meant progress. I'd trade constantly, thinking I was being smart and proactive. Instead, I was bleeding returns through mistakes and stress, paying high fees. This one is quiet but deadly. Fancy products, aggressive advisors, premium strategies. I've been pitched all of it, and for years, I didn't realize how much those fees were eating away at my future. But here's the part that changed everything for me. The best investors aren't the ones who trade the most. They're the ones who can sit still. Warren Buffett and Charlie Munger didn't become legends by bouncing in and out of the market every day. They got there by waiting. by staying rooted in their principles, while everyone else was running around reacting to every headline. And that's the real game, the one most people never learn how to play. If you want to succeed as an investor, build your plan, understand why it makes sense, and then have the courage to stick to it when it gets uncomfortable. Especially when it gets uncomfortable. Your future wealth hinges far more on your emotional resilience than on finding the perfect stock or timing the next correction. I've lived through enough financial storms to know this for sure. You, Dan T., need to be the smartest person in the room. You just need to be the most patient one.